Let's break this down in the lab. Most investors feel lost because markets look random, noisy, and emotionally exhausting at first glance. The data tells us markets grow long-term, but investor behavior shows panic selling, late buying, and poor timing again and again. In the lab, we start with evidence. Over decades, broad markets trend upward despite crashes, recessions, and daily volatility. Volatility, or how much prices jump around, looks scary short-term, but it's simply the cost investors pay for long-term growth. When we zoom out, chaos becomes structure. The mistake is reacting to noise instead of measuring long-term probabilities. Here's the framework. Step 1. Separate market movement from emotional reaction before making any financial decision. Step 2. Give time a job. Compounding only works when capital stays invested long enough to do the heavy lifting. Step 3. Balance risk and return realistically. Higher returns demand patience, not prediction or constant activity. Most winning investors follow boring rules consistently. Most losing investors chase excitement and confuse action with progress. In our lab conclusion so far, behavior matters more than brilliance. Strategy fails when emotions override discipline. Investors obsess over picking winners, yet ignore savings rate, consistency, and fees, which quietly shape outcomes far more. The data shows fewer decisions often lead to better results. Complexity feels smart, but simplicity usually wins. Time in the market beats timing the market. Missing just a few strong days can destroy long-term returns. Short-term forecasting feels scientific, but evidence shows it's unreliable and emotionally damaging for most investors. A solid framework protects you from yourself first, then from market surprises second. Asset allocation explains most portfolio results. Not stock picking, not news, not social media opinions. News exists to grab attention, not grow wealth. The lab treats headlines as distractions, not instructions. Market drops feel permanent emotionally, yet historically they're temporary phases within long upward trends. If risk exceeds your tolerance, the plan fails. Good strategies must be emotionally survivable. Rules remove emotion. Automation removes temptation. Together, they protect investors from costly mistakes. In the lab, we document decisions in advance, so future emotions can't rewrite rational plans. Consistency compounds quietly. Progress rarely feels dramatic. While it's working correctly, chasing speed increases mistakes. Controlled pace improves endurance in long investing journeys. Fees look small annually but compound negatively. The lab treats cost control as a guaranteed return. Over time, discipline outperforms intelligence. Behavior compounds just like money does. This framework doesn't promise excitement. It promises survival, consistency, and statistically better outcomes. Review your plan occasionally, not constantly. Too much monitoring creates unnecessary emotional stress. A stable framework anchors decisions during storms when intuition becomes least reliable. The lab doesn't predict markets. It prepares you to endure them intelligently. Apply the framework, test it patiently, and let evidence, not emotion, guide every financial decision. Let's go deeper in the lab. Small daily movements feel important, but statistically, they explain very little long-term performance. The data tells us noise dominates headlines, while real signals move slowly and quietly beneath the surface. Long-term investing shifts the game. Time reduces randomness and increases the reliability of expected outcomes. Investing is probability, not certainty. The lab focuses on favorable odds, not perfect predictions. Treating markets like gambling increases risk. A framework transforms chance into structured decision-making. Strong portfolios are built from boring foundations: diversification, patience, and consistency. Individual stocks scatter widely. Diversification narrows outcomes and reduces regret-driven decisions. Diversification doesn't maximize returns. It minimizes catastrophic failure, which matters far more. Progress feels slow because compounding accelerates late. Early patience fuels future momentum. Emotional control is a skill, not a personality trait. Systems help when discipline weakens. Automation removes decision fatigue. The fewer choices you face, the fewer mistakes you make. Regular contributions matter more than perfect timing. Consistency smooths volatility naturally. Rebalancing quietly forces discipline. selling excess winners, and supporting lagging assets logically. Fear spikes during declines, yet history shows those moments often reward patience most. Clear rules beat clever instincts. The lab trusts processes that function under stress. Unrealistic expectations cause abandonment. Sustainable plans match human behavior, not fantasies. Patience feels passive, but it's an active decision to avoid unnecessary damage. Filtering information is critical. Less input often leads to better output. Drawdowns are inevitable. Planning for them prevents emotional overreaction when they arrive. Recovery often begins quietly. Those who leave early rarely capture the full return. Simple decision trees outperform complex ones when emotions interfere with judgment. The lab works with ranges, not exact targets. Precision is often an illusion. Investing is about staying in the game. Survival precedes success. Repetition builds confidence. Familiar rules reduce stress during uncertainty. Calm strategies outperform reactive ones over long horizons, even if they feel boring. Effort doesn't equal results. Structure matters more than activity. Mental models simplify reality. Simpler models are easier to follow consistently. Confidence comes from preparation, not prediction. The lab prioritizes readiness. Long-term thinking reframes short-term discomfort as temporary and manageable. This framework survives uncertainty. It's been tested by data, behavior, and time. Let's break this down in the lab. Stress is not a market flaw. It's a human response to uncertainty. Volatility feels dangerous, but statistically, it's normal behavior in functioning markets. Problems begin when expectations don't match reality. The lab aligns plans with realistic outcomes. Risk is not loss. Risk is uncertainty, and uncertainty can be managed, not eliminated. Two investors see the same market. One panics, one follows a plan. Outcomes diverge quickly. Rules act as shock absorbers. They reduce emotional damage during extreme market events. Zooming out restores perspective. Distance turns fear into manageable data. Markets move within ranges. Staying invested captures growth inside those boundaries. Commitment matters most during discomfort. That's when discipline is actually tested. Investor mistakes repeat in cycles. The lab studies patterns so we don't relive them. Pausing before acting reduces errors. Speed rarely improves financial decisions. More information doesn't equal better outcomes. Selective attention improves consistency. Wealth builds gradually. Most progress happens unnoticed, far from dramatic moments. Small inefficiencies compound negatively. The lab eliminates leaks before chasing gains. Written rules outperform mental promises. Memory weakens under stress. Allocation reflects priorities. It quietly decides outcomes long before results appear. Recoveries don't announce themselves. Staying invested allows participation when momentum returns. Boredom often signals a healthy strategy. Survival comes before optimization. You can't benefit from strategies you abandon early. Emotional insulation preserves rational thinking when pressure rises. Direction matters more than speed. Long-term alignment corrects short-term mistakes. Habits compound silently. Discipline today simplifies decisions tomorrow. Ignoring noise isn't ignorance. It's intentional focus on what matters. Systems outperform willpower. The lab builds structures that function automatically. Calm decisions create stable outcomes. Panic creates regret. The framework works because it's repeatable across cycles, not dependent on luck. Evidence accumulates slowly. Confidence grows with repeated confirmation. Markets reveal behavior. The lab uses feedback to refine discipline. Stability allows growth. Without it, progress collapses under pressure. This is the lab's conclusion. Structure, patience, and behavior decide investor success. Let's break this down in the lab. Good investing starts with preparation, not prediction. Many losses come from hidden assumptions. The lab tests beliefs before trusting them. Establishing a baseline helps measure progress objectively, without emotional distortion. Investor behavior repeats predictably. Recognizing patterns allows intervention before mistakes escalate. Risk should be budgeted, not guessed. Planned exposure prevents emotional overload. Simplification reduces errors. Complexity increases the chance of abandoning the plan. Rules create upward momentum by guiding actions consistently across conditions. Distractions steal focus. The lab designs barriers between investors and impulsive reactions. Patience is a resource. Spending it wisely increases long-term resilience. Anchored expectations reduce surprise. Surprise drives poor decisions. Markets cycle, emotions follow. The lab plans responses before cycles repeat. Measuring drawdowns rationally prevents exaggerated emotional responses. Commitment devices lock future behavior. They protect long-term goals from short-term impulses. Boundaries clarify choices. When options narrow, discipline strengthens. Saving consistently matters more than optimizing returns early on. Investor skill improves slowly. Experience compounds when mistakes are limited. Regret comes from deviation, not from disciplined patience. Confidence grows from repeated correct behavior, not occasional wins. Uncertainty never disappears. Navigation beats waiting for clarity. Maintenance keeps systems functional. Neglect invites breakdowns. Results should be evaluated over years, not weeks or months. Resetting emotionally prevents carrying past mistakes into future decisions. Long horizons forgive small errors. Short horizons magnify them. Investing reveals character. The lab refines behavior through awareness. Discipline isn't restrictive. It's liberating. Clarity improves decisions. Clear rules reduce mental friction. Consistency compounds quietly, even when progress feels invisible. Anchored confidence prevents reactive shifts during turbulence. Stable systems outperform emotional improvisation over long periods. This lab-tested approach prioritizes survival, patience, and behavior above all else.